Hi guys, a very good morning to all of you. But yes, if we look at the market carnage that continues on, most indices in Asia, it is not a very good or a very pleasant sight to look at early in the morning. But we have with us Gurmeet Chadha to help us decode what is going on in the markets globally and locally. Gurmeet, thank you so much for joining us on your very special day. I'm sorry to, put you through this, but if you could tell our viewers real quick what exactly is going on? I mean, last night we've seen a very miraculous recovery, almost 1,200 point recovery on the Dow, which has been its highest recovery from 1,000 point downturn, right? So, intraday, such volatile moves are taking place on one of the world's most watched index. What is going on?
So Karan, I think this was expected a little bit. Obviously, the volatility scares us, and Fed has been printing money, and since COVID, I think the Fed balance sheet is almost touched $8 trillion. At some point of time, you have to suck out the liquidity also and raise as inflation catches up. And we had a glimpse of it in 2013 as well, when the taper tantrums played out. So I think the market is market tends to discount things early. So there is worry on that U.S. Federal Reserve is behind the curve and probably will raise rates much more than the market anticipates, other than doing the tapering, which is scaling back and reducing the monthly bond buying they have. And then there were a combination of geopolitical events, including Russia-Ukraine crisis and some at the UAE in terms of escalation building up there. So I think all of it combined, and what has happened is these days that the information gets processed so quickly, and it gets discounted, and the moves have become very sharp. And that's why you see these sharp intraday kind of moves. I personally think that it looks a little oversold to me, while markets can remain irrational for a longer period of time. And I'm not like a technical chartist and all, but if you see the PCR, it's like 0.64, 0.65. You look at FI long position, see the kind of selling they have done. So this month alone, I think it's $2.5 billion. Last 3-4 months, I think it's more than $15 billion. So I think even in terms of the positioning on India, that positioning also, in my view, has got lightened.
So, if you're saying that the market for you is looking oversold, that means it's time to buy. Are there any pockets that people should focus on? Because, by the day, it's a great time to invest, given the market has come down crashing. We've been hearing a lot of this murmur as well. What is your view on that front? Should investors look at buying right now, or should they wait to get further clarity on which way the markets are heading?
Slightly tricky one, but if you have $100, let's say as dry powder, which you want to deploy, I think maybe 25-30 rupees should start moving in. And if you see the earnings, I think financials are done really well. I was seeing even the Axis Bank numbers yesterday. 17% kind of credit growth, NIMS getting back, 1.7 times book value. We saw a stellar number from ICICI Bank. I think almost ticked
Hmm.
all boxes, right? Again, 2 times book value. In fact, I was seeing it's a 12-13p stock now on FY24 earnings, although financials are not to be strictly to be evaluated on PE front. Great digital transformation playing out. Also, look at some of the technology names getting more reasonable. We saw almost everyone reporting 6 to 7% kind of. This is not a flash in the pan. We are in a
Hmm.
clear digital transformation phase. Some of the API names. So I think you can selectively start doing it. The risk reward is becoming a little better. I would not say it's a screaming buy, but incrementally, you can maybe start putting 20-30%. And our discussion with clients, we are more client facing because we manage clients money. The question is in terms of how much to deploy on each fall, and I don't see too much right now panic. If it falls a little more, we'll have to see. But for now, the view in terms is, as you rightly said, what to pick in a market like this.
Absolutely. And you rightly brought up tech as well, given the carnage that Nifty IT index and some of these individual names have, the way they have come down crashing. But I want to talk about new age tech. Yesterday, what we witnessed for some of these new age companies, newly listed companies on the buses, is almost abnormal, right? So people who, especially retail investors who jumped on this bandwagon, who perhaps got a fair share of some of these IPO names, might be panicking right now. They wouldn't know what hit them. What should they do?
So, market has this unique ability of teaching you old lessons, Karuna. And I think the what typically happens is when interest rates go up, which I think it will go up globally. I think that what we are debating is the pace, and I still think that it will be more normalized and not in shock and awe as a lot of people think. There will be some PE rating, although
Hmm.
there's no E in a lot of these new age companies, right? So what will happen is
Hmm.
any pockets which are very, very overvalued because money was cheap and was the printing presses were rolling. I think we'll see some more correction, and the market is differentiating. So if you see the headline indices, they are hardly down 8-9% from the peak, right? From 18,500 to let's say 17,000 on the index. But if you see around more than 500 stocks in let's say companies which are above let's say 1,500 2,000 crore market cap are down more than 20-25%. In fact, a lot of them are down 30-40%. Most of these new age ones are actually almost back to their listing price, or in a lot of cases, much below the listing price. So I
Yeah.
think eventually you have to have a glide path to profitability. Even in the new age ones, the market is differentiating. So there's a differentiation happening between a food tech and companies which are into data analytics, or companies which are into D2C. There's a difference between the QSRs and the food tech. So I think the market, and this year would be that, exactly that. The market will now
Hmm.
differentiate. We've had a beta year. I think probably you are for next few quarters or maybe a year, you'll have a more a stock picking year.
But when these companies were coming to the market, or even after their listing, many analysts and many people who were tracking the markets were not happy with the way they were valued. Do you think now maybe they've corrected a fair bit and probably look attractive, at least some of them, if not all?
As I said, selectively, you can't paint
Hmm.
everything with the same brush. And I think a lot of the companies in fintech, space might start looking good with with some correction there. Same with the would be some case with D2C. But as I said, we are also learning this. This is a new. I call this as concept investing. These are different kind of businesses. So I would only
Hmm.
request investors with very high risk appetite to have a small exposure to it, and within that exposure also have maybe 7 8 10 ideas, because you don't know what will do well, what would be their business model couple of years down the line. So be selective, have a separate bucket for these. I call this concept investing, and do not just get carried away. A 20-30% correction doesn't mean it's a value stock. A stock has fallen 50% can further go down 50%. We've seen all of that, right? The core exposure should still be in companies which are boring, cash generating machines, sustainable business models.
Gurmeet, as you know, you've been part of our conversation before on Money Control. It's a live conversation. And many of our retail investors and viewers also send us a question. And one recurring question that I've seen in the last few days is, what direction will markets take, especially after what happened overnight at Dow, a 1,200 point recovery, and after falling so much, they closed 100% higher. So could that kind of a thing also happen on D Street? If not today, then maybe in the next couple of weeks. Could Nifty, Sensex also witness these kind of buying the lows sort of a pattern?
Could be, typically what we have seen is, leading up to the event, the market sells off, and post the event, you see, as I was making a point, things get processed, factored in very quickly. We are in a digital world, In fact, if you see March 20 COVID, where markets corrected 35%, it technically happened in
Hmm.
14, 15 trading days, right? So
Yeah.
things get factored in very quickly, and I think that some point of time there will be stability. I don't know too much about the bounce, but I think at some point of time there will be stability. And as I said, the market is differentiating, and that's what we should also do. There are a lot of good names in tech, in API names. API names started correcting much before the sell-off. I think
Yeah.
you rarely see a Divis Labs falling 20%, 25%, right? So even some of the good names there are you are seeing correction, and one can gradually nibble into it. Do not keep any near-term targets, because as I said, this is a global thing playing out. But we have held well despite the sell-off we have seen. I think the growing equity culture, I think, is sustaining some of this fall. We'll see how it goes. We are opening a lakh demat accounts a day, and I think this growing equity culture participation to me is a more medium and long-term trend.
Okay, just one last question on the Fed. Of course, the markets in a big way are factoring in some tightening coming by as far as the Fed outcome is concerned, but they have been, warning or rather hinting at it for quite some time. So shouldn't the markets ideally have factored that in by now?
It's we typically oscillate between greed and fear always, and and rarely you see very balanced approach. But my view is, one thing I've learned is never fight Fed or never fight the central banks. If they've created so much, I think they've navigated well through the entire COVID period. I think the normalization will be much more normal. I think we have an $8 trillion balance sheet. Even a sharp rise in yields is not very good for anyone, including the US economy. So I think what we'll see is the normalization, and not sudden shock and awe treatment, which some of the participants believe it would be. And rising interest rates, Karunya, in the initial stage typically means that economy is recovering well, demand is strong, and which is good for equities. May not be very good news for bond market participants in the initial days. And typically, if you see last 20 years, initial hike of rates, and if it's nominal rate hikes, three or four hikes in a year, are actually good. And we are also in a period where our earnings growth after a long time are probably growing at 20%. So I see it as a positive in the long term, and some volatility in the near term.
So, what has been your biggest lesson or takeaway after what happened in the last couple of weeks in the market, and what do you think investors should also adopt as their mantra after seeing this, or seeing it perhaps for the first time? Many of these new entrants who have started investing and trading.
So the first lesson is never extrapolate near term trends both ways. We tend to get carried away thinking market's not going to go up week after week, month after month. So if you see our average returns of index is 14% for last 20 years, but there've been only 2 years where it has given 14%. So either you're on the plus 20% side, or you're on the single digit side or long side. But in last 20 years, there have been only 3 years where market closed negative in a year. So
Yeah.
overwhelmingly, we tend to do well. So think a little more medium to long term, and track earnings more instead of just tracking what is latest and what is in fashion. I think if you are
Hmm.
getting into companies which are growing profits, I think eventually, I think that old textbook rule still works.
You know, I thought I will let you go on time today, Gurmeet, but I can't help but ask you on the budget as well, a big event coming up for the Indian markets as well. So, do you see some more jitteriness prevail ahead of the budget? Last year, what we witnessed right after the budget was definitely phenomenal. But what's likely this time around, according to you, given the backdrop?
I think the market is going with very little expectation. I think that to me is the biggest positive. So I think there will be something for agriculture, because we have a lot of state elections, and that part of the economy, the informal sector, the agriculture has been impacted more by COVID. So you expect there. So maybe fertilizer companies, agrochemical companies could be in focus. I also think the infrastructure thrust will continue. So the capital goods space, and the overall investment cycle playing out, I think government would be supportive. So I don't think the market is building up too much expectation. So if the government continues the focus on the government-led capex revival and focus on agriculture, it might just turn out to be a little positive for the markets.
All right, Gurmeet. On that note, I would like to conclude this conversation. Thank you once again for joining us at such a short notice and sharing your insights and your learnings with the market, from the market with the viewers of Moneycontrol. It's always a pleasure having you.
Likewise, Karuna. Have a good day. Thank you. Thank you.